Welcome back to the Financial Shepherd Podcast. My name is Joshua Casey Garland, certified financial planning professional and owner of Shepherd Wealth Management. Very excited today to be shooting episode 15 of the Financial Shepherd Podcast. We got a lot of really relevant and important topics to go over with everyone today, so I'm very excited. But before we get into that, one real important announcement is that we're going to end season 1 of the Financial Shepherd Podcast today. And then we'll pick up with season 2 here in just a couple weeks. A lot of people, clients, fans of the show really have enjoyed this podcast. It's a little bit different than probably a lot of other things that they're watching on TV on a regular basis. And we want to celebrate that, but we also want to make some additional investments and changes with the podcast to make it just a better experience to those that love watching the show. So we're going to make some investments and some changes. It's going to be very exciting, and more to come on that when that actually happens. But the topics that we're going to go over here today, we're going to start out with some fun, positive news, and we'll get into probably what's on everybody's mind here. But we'll start with the Elon Musk making a big investment in Twitter, joining their board. We'll also talk about the student loans. Biden and his administration has deferred or delayed the repayment of those loans through the end of August, and that may continue throughout the remainder of this year. So we'll talk a little bit about that. And then lastly, I think what's on everybody's mind, what's certainly affecting the stock market and corporations around the world, is this increase of inflation and how central bankers are trying to fight this inflation issue that we're all dealing with at the moment. So let's start with the fun stuff here. So Elon Musk making a big investment. He is a 9.2% owner of the publicly traded company and social media giant Twitter. Now, in this investment that Elon Musk has made, he is capped at, I think it's 14.9% is the most that he can own of Twitter until he either leaves the board at some point in time in the future. It's a big deal, not just for, I think, Tesla followers and shareholders, but it certainly has helped Twitter stock quite a bit, having its best one-day performance after that announcement actually occurred. Twitter was up 24+% in one day, and it had a couple 3 or 4% increases the following day. So that was obviously a huge win, I think, for Twitter shareholders, and certainly for the long-term, prospects of future growth for the company. Certainly, Elon Musk is a innovator. I would call him our modern day Albert Einstein, with all the things that he's kind of been able to create that I don't think a lot of people, including myself, when Tesla got started, would be able to compete with the big automakers and doing something completely different that's never been done before. So my hat's off to Elon Musk, and I'm excited to see what he does here with Twitter, because I'm not really sure how he takes what he did with Tesla and applies it to Twitter and their platform and what they want to do in the future. But I think the odds are in Twitter shareholders' favor, to steal a famous line from the Hunger Games, that the prospects for future growth are certainly bright. And the share price certainly reflected that after that happened. So we'll look and see what happens with Twitter and Elon Musk there.
That's a bold move, Cotton, with the Albert Einstein reference.
I can't point to any other person from an innovation standpoint. I mean, you can maybe throw a Mark Zuckerberg in there, what he did with Facebook. That obviously happened before Twitter came around. Mm-hmm. And I'm maybe blanking on some others there, but I really cannot imagine. All I can think of is when I was a kid in school, like elementary school, every teacher I had in every science class says, we're going to run out of oil and the world's going to come to an end because we got to be able to
peak get oil was the thing for a while. Remember?
And I always just took that. I was like, well, we'll figure out something. Yeah. Right. I was a young man and I knew enough about the world to know that there'll be some sort of innovation happen, but I never in my wildest imagination would thought that we would have a car that runs on electric power and can go 500. I think some companies are trying to generate a battery that can go 1,000+ miles.
Right.
Like that's unfathomable to me, and that's why I'm giving him that sort of props.
Yeah, I mean, you were the pilot of this SpaceX rocket to Mars, so far be it for me to in any way disagree. Howard Hughes comes to mind for me when I think of Elon Musk. Definitely a modern day Howard Hughes, and obviously technology and just things in general are different from where Elon gets to stand from where Howard stood, right? There's different perspectives, there's different problems to solve, there's different things. Just technology in general is further along, so the dreams that he can have are much larger.
Yeah, 2 points. I mean, we could probably do a whole podcast just on that one topic. First of all, anything's possible if you have the desire to make it a reality.
Oh, yeah.
It's going to take a lot of work, of course, and there's going to be a whole bunch of naysayers and people that'll doubt you, but Elon Musk didn't really care about any of that sort of thing. He just made it happen. He made a reality that, at least for me, and I'm sure for a lot of other people, on this planet, just can't imagine, all the things he's doing with the space technology that he's come out with, having rockets being able to go into outer space and then land on their own exactly where they want it to land. I mean, it's just awesome. So I'm excited for Twitter and their board and the shareholders. We'll see what happens with the stock. But the student loans, this is like maybe for personal reasons. I went to undergraduate school and graduate school. I have student loans. I've been paying student loans for at least 10 years now, and I have a long way to go before I get all these things paid off. So I'm very excited to hear that the Biden administration has deferred student loan payments yet again. That started with the pandemic in March of 2020. The Department of Education hasn't received any payments except for those that wanted to make the payments at zero interest while this is going on. So hopefully maybe they'll just come to a conclusion like, hey, we don't really need these payments to come from all of these, young adults who have graduated from a university, maybe some that haven't, and they're being, really burdened with significant payment. In a lot of instances, that payment might be as much or more than their mortgage or their rent payment. So for me, for selfish reasons, I would certainly love to see a washing of the hands, if you will, from the Department of Education with all these student loans, at least to some degree. I know that was part of Biden's administration's agenda, was to figure out a way to help those that have student loans be able to make investments not only in themselves, but for their future, whether that's buying a home or starting a business. If they can get this burden of financial debt, off of their personal balance sheet, I think that's a huge investment in the economy that really doesn't impact inflation or any of these other things. It really just gives more cash back to those that are typically going to be younger adults like myself that are trying to carve out a space in this world.
Yeah, I think that, all the con arguments that you hear for waiving student loan debt, they don't acknowledge what a boost to the economy that would really be, because most of us that are afflicted by the scourge of overhanging debt, we're wanting to put back into the economy. You take that money and invest it in other places. And for someone personally, that struggled with student loans, if I hadn't had a massive stroke of luck myself, I wouldn't be in a position to be doing any type of other investment. Everything would be going to alleviating that debt.
Yeah, I mean, I just think of my own situation. I think, and I haven't made a student loan payment in a couple of years now, so I'd have to pull this up and look at it. I might get locked out if I tried to just log in blindly. But I think it was around $500. So just imagine if that was your payment. And some people are paying a lot more than that.
Yeah,
some
I was
people,
at $700.
Yeah, I mean, if you $500-700, some people maybe $1,000 or somewhere in that ballpark. Instead of having that money come out of their paycheck every single month, and that could be applied to maybe paying down their credit card, or maybe making an extra payment on their mortgage, or saving some additional money for retirement, which is a huge concern, not just from a political standpoint, but just any survey that you want to pull up from any year over the last 20 years. Americans' number one stress in life has been their financial situation.
Right.
And I'm sure I could go back farther than that on surveys that have probably been, showing the same sort of data, is that people just don't feel like they're prepared financially for retirement or heck, even an emergency.
Yeah. Yeah. I mean, just having that money sitting there in case the sky falls, which,
it's going to happen in life. Right.
Yeah. Not to mention, hey, I need a car to get to work. Well, I can afford one.
Yeah. I had a water heater, I had a, not just a water heater, but my HVAC go out in my house a couple of years ago, $14,000 for a brand new HVAC. Right. And maybe like $2,500 for a new water heater. I mean, these are just normal things that are going to happen.
Right.
Dishwasher is going to go out. Going to cost you about $1,200 to get a new dishwasher, if you can even get one right now with all the supply chain issues. So hopefully this actually sticks around for longer than the end of August. We'll all wait and see, but it's certainly something I'm excited about. And I'm sure all of those folks with student loans out there are as well. And then the last thing that we want to talk about today is inflation. Obviously, we were at a 40-year high inflation, right about 8% on the inflation number, which we haven't seen anything like that since the 80s. And really, how is the Fed going to hopefully have a soft landing? They've never really been able to produce a soft landing, and all the information that we're recently getting here over the last couple of days would indicate that it's unlikely that they'll be able to land this plane perfectly, reduce inflation without causing the market to have a recession. So I've gotten a lot of questions from clients about that. It's my number one concern for 2022. Everything going on in Ukraine certainly is devastating, and it's something I hope to see end very, very quickly. But that actually doesn't have historically as big of an impact on the stock market and investors as something like runaway inflation. So I want to make sure that we spend some time talking about that, addressing some questions there. So those are the three topics of conversation. And since we just left off with inflation, that's kind of where I want to transition to. So the inflation and the stock market. Again, we're at 40-year all-time high inflation. So what does that actually mean for investors? Well, really what it should mean first and foremost, before we start talking about all the negative things, the reason why we have high inflation is because the economy has been exceptionally growing at a rapid rate for the last 5 years, really. The last 3 years, we've had 20, 30+% returns in the S&P 500, even though we've had a global pandemic and the whole country and corporations had to shift from show up to the office, Monday through Friday, 9 to 5, to don't come back to the office for the foreseeable future. But, oh, by the way, we're still going to be able to sell stuff and make products and services that are going to keep this company, growing. So first and foremost, the first thing that comes to mind when we talk about inflation is it just means the economy has grown a lot in a pretty short amount of time, and demand is exceptionally strong for the products and services that we have here in this country. So take it with a grain of salt as opposed to going directly into the negative. And the negative is, how does this inflation affect the market? Well, as inflation's going up, the Federal Reserve's mandate is to try to keep inflation in check to around a 2.5%, maybe 3% annualized inflation. That's what they want to be able to do. Now, why do they want to do that? Well, if we just let inflation run forever, well, the cost of a plane ticket's going to be triple here in 18 months, or the price of going to the movies is likely going to continue to increase. So if the Fed does nothing, doesn't mean the economy is going to have a big issue immediately, but it will have a very big issue well out into the future if they just don't do anything about it. And that's what we saw in the 1980s, where inflation was 16, 20, 22% of its high. It made it very difficult for first-time home buyers to buy a home. A lot of my clients today that are getting close to retirement or already in their retirement years, they lived it. I was just reading about it, but they actually bought their first home and paying 20% interest. Now, obviously, rates went down coming out of 1982 all the way up until what we've experienced here recently in 2021. Now rates are rising again. There was this bond bull market for 35 years where rates continuously went down and down and down. But if we had the foresight to know what was going to happen here today, you could have literally bought a 30-year treasury bond backed by the full faith and credit of the United States government and received somewhere close to 30% interest every year for 30 straight years, right? That's unbelievable. If that ever happens again, I'm going to take all my money out of stocks. I'm going to buy the 30-year, and I'll take that 20+% annualized return every single year. However, there's always something about inflation and interest rates that really just makes people not feel good, saying, okay, the Fed is increasing short-term rates. Well, what does that actually mean? Why are they doing it? We just went over why they're doing it is to hopefully control inflation, not let it get rampant like it did in the 80s, where we have, the cost of everything being way more than it ever should be for everyday individuals that go to work and have a family and want to be able to save and retire and put their kids through school. So we get why the Fed's going to increase rates. It means that the economy is very healthy. But we have this bearish sentiment, meaning that rates are going up, therefore all stocks are going to go down. Like that's what we've really seen in January and February, where the market has, a 10+% correction in the S&P, nearly a 20% correction in the NASDAQ. You just get this bearish sentiment. And I get the bearishness because as rates go up, that certainly can hurt certain sectors of the market, and specifically wanted to talk about technology. Because as rates go up, specifically we'll look at the 10-year. The 10-year is hovering around I think about 2.65%, which we haven't seen that in quite some time. That's the risk-free rate that analysts will use to discount future cash flows for corporations. So as that rate goes up, it makes the present value of all those future cash flows worth less. Hence, you see the stock prices going down. But not all companies, specifically in the tech sector, are created equal. There are a lot of companies that don't have earnings, or they're losing money on a regular basis in the tech sector, and they did great in 2000, 2001 when interest rates were zero, right? But now those types of companies are down 70, 80, sometimes 90%. If you look at the Cathie Wood ARK Innovation Fund, those are the types of companies I'm referring to. And I think Cathie's an innovator. I think she does a lot of good things for shareholders. She's definitely somebody that's looking well out into the future. However, those types of companies with hardly any earnings or negative earnings, they should get beat up pretty bad when rates go up like that. But you should not throw the baby out with the bathwater, because there are a lot of very large tech companies that have a fortress balance sheet. Apple is the first one that comes to mind. Apple's 7.2% of the S&P 500 index. They're nearly a $3 trillion company. Fun fact, the last time that a technology company was that big of a weighting on the S&P 500 was 1984. As the question is, what company was it? It was a technology company. You do know it. It is IBM. I asked that question to a lot of my clients recently. They had no idea.
I'm sorry, International Business Machines.
Yeah. So why is IBM not talked about hardly by anybody anymore? They stopped innovating. They stopped looking into the future. They got pretty happy with the way things were going. They probably thought that that would continue forever. And Apple was a penny stock at that particular point in time. So if we don't look out into the future, which, again, I think the Cathie Woods of the world have the right mindset, because technology is the biggest sector of the S&P 500. If we don't have tech participate in a positive manner, you're just not going to see, the major indices have a positive year. Mm-hmm. However, the Apples have a fortress balance sheet, like $200 billion worth of just cash, right? And they're not making money just based on iPhone sales, although that's a big catalyst for their growth. They make money by Apple TV subscriptions, which I love. You get to watch Ted Lasso and a whole bunch of other really cool shows
Ted
there.
Lasso.
Right? I can go, that's a different podcast.
Yeah. That's episode 16, season 2.
Yeah. But they're making money with their tablets, with all the things that they do from the app standpoint, from a advertising standpoint. They make money in a lot of different industries, specifically sub-industries within technology, which really just, to use the words of Warren Buffett, they're building a very wide moat of safety, right? So I loved watching Vikings. I'm sure a lot of people probably watched that show. If you were in Viking day times, well, you felt a lot safer if you had high walls, a big moat, right?
Right.
If you had a lot of resources to protect your land. Well, that's exactly what these large corporations are doing. They're able to weather the storm, right, when they're being attacked, and attack is inflation right now. And they're the types of companies that can pass along these inflation pressures to their customers, because we simply are not going to stop buying iPhones just because inflation's at a 40-year high, right? We're still going to use all of their products and services. And those are the types of companies that can weather this type of volatility. They should not be put in the same category as a lot of other technology companies that have really been beaten up the hardest. But the truth of the matter is, a lot of investors are either through mutual funds or through indexes. Well, Apple's the largest position of all of those indices. So when you go hit that sell button, it is in fact impacting those that own the individual share price on the short term. But in the long run, earnings are really what drives the market. So these companies, which I expect them to still produce very strong earnings ahead of all of these headwinds, and you're likely going to see a very violent V-shaped recovery, specifically if we get a ceasefire announcement over in the Ukraine, and if the inflation numbers come down at all, like just a little bit, half of 1% would be great. 1% would be phenomenal. Anything above that, you're going to see a violent move to the upside for equities and specifically technology. So that's the very first thing I want to talk about with inflation in the market. Now, my big concern, the Fed has to increase rates. We already talked about why. It's because the market's very healthy. It's a good thing that they are doing, even though it's short-term pain. But the one thing that the Fed cannot control as it relates to inflation is commodity prices. Natural gas, oil, all of those different commodities. That is the best performing sector in the S&P 500 this year. I mean, energy as a sector going all the way through yesterday, beginning of the year all the way through yesterday, energy is up nearly 37%, right? That's not going to last forever, but as soon as the supply can keep pace with demand, and that's the real problem here. There's a supply and demand dislocation, and the Fed has no control over that. They can raise rates and raise rates and raise rates, but they do not have any impact on the supply of oil eventually meeting with the demand of oil. So that is a concern for me because obviously these types of commodities are what we would use to ship things logistically. It's what we would use to make things like chips, obviously to heat our homes and our businesses. That has a overlap with every business sector. All parts of the economy around the world will be impacted by these commodity prices being, elevated, and they're likely going to be elevated for the foreseeable future. Even if we get a ceasefire in Ukraine, well, that doesn't necessarily mean that we still have all the supply of oil, right? It doesn't mean that Europe's getting all the natural gas that they're going to need coming into this winter. So you're likely going to continue to see these commodity prices stay elevated. And the Fed really doesn't have a whole lot of control over the inflation pressures in the commodity and energy space, even if they increase interest rates, because we're all still going to have to put gas in our car. We're all still going to have to heat our homes. And it doesn't matter how much, inflation's either going up or down as it relates to those different things. So that will have an impact on earnings to some degree. And we're going to find out how big of an impact that's actually going to be here in Q2 and Q3. So I do expect strong earnings, but I'm really, really interested to see how some of these commodity price pressures have really affected corporate revenue and their ultimate bottom line, their earnings per share. And the last thing I wanted to get into before we answer some questions is inflation as it relates to the volatility index, or what they call the fear gauge, or the VIX. Ticker is VIX. So first of all, what's the VIX? The VIX is just it's an index of options on the S&P 500. So it's really a gauge of how investors anticipate the S&P 500 moving either up or down over the next 30 days. And generally speaking, if we have the VIX hovering around 20 or lower, that means the fear gauge is very low. And typically you're seeing the stock market moving up and to the right, where almost all sectors, it feels like, are in the green when that's the case. And I wrote about this in my most recent newsletter to clients that I send out every single month. So if you'd like to get the newsletter, a copy of that, certainly reach out to me at 513-630-2664. But the main highlight as it relates to the VIX in this newsletter was as the VIX moves into that 25 to 30 range. So the VIX is moving higher. That means the fear index is increasing, which simply just means that the average investor really is worried about future growth of the market for at least the next 30 days. So when it hits that 25 to 35 level, it can certainly blow way past that. It has during events like the pandemic of March of 2020. It blew way past that in 2008. So it can certainly go way higher than the ranges I'm referring to. And this is not a end-all, be-all approach towards when to allocate capital into positions that you either own or don't own. But generally speaking, it's a good time to pull out your buy list when you see the VIX in that 25 to 30 range. When I see that happen, it's generally so far this year been a really good indicator for a buying opportunity for positions I either already own that have come down in price, or maybe positions I don't yet own and would like to own that have come down in price. And I don't push all the chips into the middle of the table. I don't go all in, but it is an opportunity for me to rebalance the asset allocation for my clients and pick up shares at a lower price. It does not predict the bottom of the market by any means. And this sort of approach at looking at the volatility index does not work in every single market scenario, all market conditions. But right now, when we're dealing with inflation at 40-year all-time highs, we're coming into a midterm election year. We got a geopolitical event going on in Ukraine and a whole bunch of other pressures from the supply chain to energy prices that these CEOs of corporations on the S&P and the Dow and the NASDAQ are facing. It is elevating that particular fear gauge. And I like to take my cues from Warren Buffett. I've said it many times. Buffett still is practicing what he's preaching here today, in that we want to be greedy when others are fearful. And we want to be fearful when others are greedy, because the fact of the matter is, if we're a long-term investor, I don't really care about what happens today, tomorrow, next week, or even next quarter, or even for that matter this year, because I do know over the long haul, the market's up about 70% of the time. which means it will be down about 30% of the time. And when it's down, I want to have a game plan for how I'm going to benefit from everybody else's emotions. And that's a good way to get an indication of where is the market from a sentiment standpoint, at least looking out over 30 days. And then if I have earnings coming up like I do here in April and May, I might want to add a little bit more or subtract away from some of the investments just so I have the capital if earnings don't come out the way that I hope that they would come out. And now I can, again, buy shares at a lower price. So the VIX is a good indication for the fear gauge of when you might want to consider being a little greedy, to use Warren Buffett's words. It also can give you an indication of when to be a little fearful. So you see that VIX drop below 20, might be a good opportunity to rebalance, take some profits, and position yourself for the next downturn. So we talked about inflation, I think, at a pretty good length here. I think we just kind of talked about how you can control your asset allocation as it relates to what the Fed's going to do with interest rates and how the market's trying to price in what the Fed is actually going to do. Are they going to do 25 basis points or 50 basis points here in May? We're not for sure, although the news would indicate that there's probably a bigger probability now of a 50 basis point hike as it relates to 25. But the last thing I wanted to share with everybody, and I talked about this in our last podcast, you can control two things at all times, regardless of what's happening around the world, who's president, what interest rates look like, etc. We talked about controlling the asset allocation here just a couple minutes ago. And the other thing that you can control is your temperament. So temperament just means, how do you actually respond to the market and the positions in your portfolio when you get this volatility? So you have to ask yourself, what is my risk tolerance? So I want to share a little bit of information with you, and maybe this will help you understand a little bit more about what risk tolerance means and what it might mean to you as an individual investor. So Amazon. I'm a big Amazon fan. I'm a big Amazon shareholder for my clients here at Shepherd Wealth Management, but that stock lost nearly 90% of its value in less than 18 months when the dot-com bubble burst in the early 2000s. Additionally, between October of 2007 and November of 2008, Amazon lost 65% of its value. And then between September 4th, 2018 and Christmas Eve 2018, so that's a small period of time, Amazon lost a third of its value, right? However, here's the good news. Even if you bought Amazon stock at its peak right before the dot-com bubble burst on January 3rd of 2000, and you suffered through all of those declines, you would be sitting on a 3,500% gain as we're talking about this. And that's as of the end of March.
I don't want it.
Yeah.
Don't want that.
Yeah. So the ride down was obviously very painful. And it happened more than once.
Right.
Over, sometimes a short span of time, sometimes not that long of a span of time. But even if you bought it at its peak price, today you'd be sitting on a 3,500% gain. And let's do the quick math on that. So that was in 2000, right? We're in 2022. So we've got 3,500 divided by 22. I don't know. It's a cool 159% average annualized return.
I think I can speak for everyone and say that that's acceptable.
Yeah, and I guarantee you the guy or gal that sold out on all these different events that happened with Amazon was throwing the baby out with the bathwater, because they were taking Amazon and they were putting it into the same category as all those other tech stocks that were brand new that maybe didn't even have an order, right, for their product or service, right? That's what happened with the dot-com bubble, right? All these companies that in many cases didn't even have an order on the books yet were promising that they were going to do all these cool things with technology, and they have this, ability to serve customers through the website and all that good stuff. Well, that's what happened with the dot-com bubble. And Amazon, obviously, in the tech sector was part of that sector and lost a whole bunch of value just like everything else did. But the one thing that investors probably didn't sit down and ask themselves is like, what is my real risk tolerance? Okay, well, I understand that I need to have some exposure to technology. Let me check the story on Amazon. Let me check a little bit of information about this guy named Jeff Bezos, who nobody knew, back in the early days of Amazon, right? Let me check a little bit about, what they want to be able to do in the future. Are they just going to sell books online forever? I mean, that was my thought when I was in college and all this stuff was happening. It's like, really? They're going to create a publicly traded company in the tech sector and just sell books? Like, obviously there's more to the story than that. And those folks that had the right temperament, and by the way, the right asset allocation, because you can't have all of your eggs in one basket. Everybody should know that at this point. They were able to look at the story and hang on, and they were rewarded for that. So your temperament, in Warren Buffett's words, he would hire somebody that has a better temperament than a whole bunch of college degrees, right? Because we are all hardwired with fear and greed going back to caveman days. That's never going to change. And we feel our losses twice as much as we feel good about our gains. So it's important to control the asset allocation, the percentage of your money invested in stocks, bonds, and cash, and the percentage of your money that you would allocate towards individual companies or an ETF, like an Amazon. But the second, and maybe the most important thing over the long run to have success is being able to control your temperament. When all these events happen, it is going to happen. If you go back 100 years in the market, almost every single year, not in all years, but darn near every single year over the last 100 years, knowing that the market's up 70% of the time and down 30, almost all of those years had at least one 10% pullback in the S&P 500. So you have to be willing to accept that as a long-term investor and just be able to control the two things you can always control, which is your temperament and your asset allocation. So those are my thoughts on some of the big topics that we wanted to cover here today. As I know we got some good questions.
We do, yeah.
So let's go ahead and start with the first one. I think we got time for a couple here.
Okay. Well, Brian's back. Brian from Shepherdsville, texting in. Should we expect a recession now that the yield curve has inverted?
That's a great question. So that's been coming up quite a bit. And I do have some data here to share with the listeners and viewers of the program here. So let's share the data, and then I'll riff a little bit on my thoughts. So let's see. So what is a yield curve inversion? First of all, for those that are maybe not familiar with that specific terminology, it's when the 2-year Treasury yield and the 10-year Treasury yield fall below, or the 10-year falls below the 2-year Treasury yield. Right. So now you're getting a better rate of interest on the 2-year as opposed to the 10. Now the yield curve is inverted. So the question is, should we expect a recession? Not necessarily. First, it's important to remember that while a yield curve inversion has preceded each of the past 8 recessions, so it is a good indicator of a recession, and that's going back to the 1970s. So I understand the question. But the most recent inversion was in 2019. And it did not predict the coronavirus pandemic, of course, that caused the market to sell off quite a bit in March, but instead indicated the economy was slowing down, hence was susceptible to downside risk. So in 2019, the stock market was actually positive 28%. So not in every single instance will a yield curve inversion produce a recession. However, we have some additional data points here. The duration between the yield curve inversion and a recession has varied between 10 months and 3 years. And the average duration is around 1.5 years. So even if the yield curve is a signal that we take literally that a recession is going to happen, it likely wouldn't happen until sometime in 2023, about 1.5 years out. And the U.S. economy can be described as robust right now, in my opinion, because GDP growth is trending around 4%. The labor market over the last several months has been adding, on average, 600,000 jobs. And the unemployment rate has fallen to 3.6% in March, which is just above its pre-pandemic 50-year low of 3.5%. So, yes, yield curve inversions do indicate that a recession is probably likely, but it hasn't happened in all instances. And the average time between when a yield curve inversion happens and we actually see a recession is about 1.5 years. So I would answer the question saying you could probably begin to anticipate, both with your asset allocation and your temperament going into 2023, that a recession could actually happen. We'll have to obviously understand what inflation looks like, what the Fed may or may not be doing with rates, and a whole bunch of other things will factor into whether or not we actually have a recession. But it doesn't indicate it's going to happen 100% of the time. And it doesn't necessarily last all that long. So you have plenty of time to sort of prepare yourself if you do anticipate, this yield curve inversion causing a recession. Just know that it doesn't happen overnight, and you can still benefit from the market's growth between now and then. So you still want to have an allocation towards equities. But that's the information, and I don't know if it's going to cause a recession in 2023 or if it's going to happen in 2022. I think a really good place to start to get an indication of whether or not we're going to have a recession is the corporate earnings announcements that we're going to see here in Q2 and probably even more important in Q3. So if we get positive earnings growth like what the market's anticipating, then I think you can probably hold off on your fears of seeing a recession in this market year of 2022. Of course, we still have this presidential midterm election, and we still have this geopolitical event in Ukraine, which could go, 100 different directions. So if I just had to give an answer for is the yield curve going to cause a recession, maybe. I think it's fairly unlikely that it'll happen here in 2022.
Yeah, I think important thing is to keep in mind all the other factors that point to it, like you mentioned, unemployment, GDP, all those other things that can also signal a recession.
Yeah, I mean, these are great numbers. I mean, if we didn't have 40-year high inflation and we didn't have a geopolitical event going on in just a midterm election year, and you were looking at all this job creation, all the growth that we're seeing here in GDP, I would say that we're probably going to see another double-digit type of year on the major indices. But the fact of the matter is that's not the case. We got other headwinds to worry about as well, and an inverted yield curve is not something that really keeps me up at night, at least not at this point in time.
Looks like we got time for one final question. First-time texter, first-time text line. Pooja from Cincinnati is asking, what sectors of the market should I invest in to protect my portfolio from all the volatility in 2022?
Yeah, that's the $1 million question, right? Like, where is the best place to make the most money with the least amount of risk? Like, that's a normal question. Yeah. That's the question I get all the time.
I feel you, Pooja. We're right there with you.
Yeah, like, hey, can we make the most money possible every single year with the least amount of risk? I think that's everyone's goal.
Right.
There's a way to do that. Again, asset allocation, temperament, but I want to be specific here with my answer. So what sectors of the market should I invest in to protect my portfolio from all the volatility in 2022? Let me start with cash. Cash, if you have cash in a brokerage account, your IRA, or wherever, you're not going to see a loss on your statement when you get that statement every month. Right? It's just, you're not going to see any red because it's cash. You maybe got 0.01% in interest, but you're not going to see any red numbers on your statement if you own cash. But here's the thing that you're not seeing is the fact that we're at a 40-year high on inflation. So if we want to call inflation at 8%, which is right about there, maybe just under it, any amount of money that you have in cash, if it stays in cash for the entire year, well, you have a real return that's a negative 8% if inflation stays at 8%. You're losing purchasing power. So what's the next less risky investment? Bonds, fixed income, right? All right, well, if the 10-year treasury is only hanging out about 2.65 and the 30-year is not paying any much more than maybe like 2.68, something like that, it's pretty darn close. Well, your real return, even if you were to sit on that bond and collect those interest payments, let's say you're getting 2.5% in interest over the next 10 years. Okay, you get the 2.5% interest. That was risk-free. But if inflation stays high, let's say 7-8%, well, your real return is still negative, right? There is not a bond on this planet in 2022 that's going to make any money for anybody. I guess if you can accept the fact that you're going to have a negative return and you're not going to see any fluctuations in the actual principal value, sure, I guess that's a lesser of two evils as it relates to just having cash, right? You're probably less negative, but you're still going to be negative. And the number one asset class that will protect you from things like inflation is the stock market. But you cannot participate in the stock market without experiencing volatility. Now, the specific question here is what sectors? Generally defensive sectors like utilities, communication services, so think your telecommunication companies like your Verizons and AT&Ts, obviously utilities. I think everybody gets that. The companies that produce the electric and the Duke Energies of the world. Those are safe sectors of the market to be in. Your home, outside of just stuff that you can actually purchase, is also a good place to protect yourself against inflation. I'd say the next sector of the market, obviously energy. Like we talked about earlier, people are still going to have to heat their homes. They're going to have to put gas in their car. We talked about how energy is leading the way, not just last year, but it's a huge outperformer so far this year, being up nearly 37%. And the last sector of the market that's probably going to produce some stability would be the healthcare sector, right? People are still going to go to the doctor, still going to have their checkups. If they have an emergency, they're still going to go to the hospital. And companies like United Healthcare and any real organization as it relates to the healthcare sector will benefit from the fact that people are going to still pay their premiums. They're still going to go, visit their doctors. So those are sectors that are defensive in nature that generally will produce positive returns in a year like we're seeing right now. And that actually is very much the case. So utilities are up 5.3% so far here as of the end of yesterday's market close. The healthcare sector is hanging in there right around the flat mark, which is still way better than what a lot of these other sectors are doing. And then energy, of course, being up nearly 37%. So those are the sectors that you could look at to anticipate some stability from a lot of volatility. However, you're not immune to the volatility. Telecommunications, the communication services sector is still down 10.6%, as of the end of yesterday. So there is no real way to shelter yourself from all market volatility. And if you want to fight inflation, you certainly have to be a stock market participant. What I would suggest, though, is owning companies in those spaces along with, again, this is all about diversifying and controlling the asset allocation, having those other sectors in your portfolio, maybe at a lighter weighting. Maybe you don't have as much of a percentage in technology as you once did. Maybe you don't have as much in, consumer discretionary as inflation's going up. But it still is a part of a well-diversified portfolio. And if you get gains in your energy ETF or your utility stock, or if you're a Berkshire Hathaway investor, that's done phenomenal this year. It's a conglomerate of a whole bunch of different companies in all kinds of different industries. It's essentially a mutual fund in and of itself. Those companies are doing great. But you don't just sit on that and ride the wave all year. You got to have the discipline to take profits off the table. I'm not suggesting that you would sell every gain for any of those types of positions. But what I would do, if, for example, Berkshire is a 3% holding in my client's portfolio and it goes up seemingly every day right now, and now we're at 5%, okay, maybe I'll take 2% of profits off the table from Berkshire, and I have an opportunity to either rebalance into something that has underperformed, like the technology sector so far this year, or I can just simply sit on that cash knowing that I'm losing some purchasing power in the short term, but the goal is not to leave it in cash all year. The goal is to opportunistically apply that capital to positions and sectors that have underperformed. So I think it's a great question. There is not a magic pill that I have to give to protect anyone from all volatility, but I think we described, starting from the least risky asset class to the most aggressive about how you might want to think about positioning your portfolio as it relates to sectors in a market that's going to be volatile, at least for this short period of time that we're talking about right now. So those are great questions, Az. I don't think we have any more time for a third one, but
we don't know.
What I wanted to wrap up with is, again, we got some really cool stuff coming out with the Financial Shepherd podcast. So please stay tuned. Go to the website, shepherdwm.com. There's links to my YouTube channel to watch prior videos. There's also a link on the website to download the Audible version through Spotify. And then, of course, there's a whole bunch of information about my background and experience as a certified financial planning professional. Don't forget to follow us, Shepherd Wealth Management, on Facebook, Instagram, and Twitter. It's been a blast going through the topics that we have here today and answering some of your questions. Certainly look forward to doing this again in the next couple of weeks. Hope you all have a great day.